We'll do it live.
Okay. No.
We'll do it live. Fuck it. Do it live. I'll write it and we'll do it live.
Hello, this is Dylan Moore and Nima Bajur of Irina TV coming to you. We're doing it live on March 29th, 2023. It is Wednesday, and today we got to talk about some banks. Nima and I have been chatting about this in the background for a while. Ever since the Silicon Valley Bank crash, we felt the necessity to make a show, but we weren't privy to the details, and Nima has gone and looked up some details for us. I'm pretty excited about this because I haven't seen it myself yet either. So Nima, welcome back. I should welcome myself back. I was in Japan for the last 3 weeks. But welcome back, everybody, including me and Nima. Konnichiwa. Yes. Nima, just before we get into this, I just wanted to say I actually went to a bank in Japan to look up buying a house. Do you know what interest rate they said we would likely get?
Like 1% or so?
0.3.
Wow. For a 30-year?
For a 40-year.
Wow.
Immediately I was like, can I just start gobbling up houses for free in Japan and turning them into short-term rentals? Right. That's still a possibility. We were there for 2 kids. It was hard to make it to the bank to have these conversations. But
I mean, it's amazing given that the prices have also come down so much. And the rates are so, like over the 40 years.
Well, there's so many people dying in Japan. For every one person that's born now, 2 people die. There's just too many fucking houses.
Yeah.
It's wild. The government is literally giving houses away because they have so many empty houses that apparently, the person dies, nobody inherits it, and it just goes back to the government. That they're literally giving houses away.
Right. So this is always, to me, Japan is a cautionary tale because people always say real estate will always go up and up and up. Well, no, well, not always. We have a big example here where it's not the case.
Yeah. I was also told, I haven't confirmed this yet, and would only be able to do this because I have a Japanese wife, 0% down.
Wow.
So I can get a 40-year loan, 0% down at essentially 0% interest for a fucking house. Which are way cheaper than here to begin with, right? I mean, like 1/2 or 1/3 the price. It's wild. Anyway, I bring that up because I was recently in Japan and we're about to talk about banking. Silicon Bank crashed. No, actually, it didn't crash. It was closed for reasons that may have been stupid, as we're about to get into. And either 1 or 2 more banks have gone after that. And the whole audience that we're used to discussing, not our audience, but people who typically report on such things, are going, Peter Schiff, for example, it's here! It's finally happening! The whole shit's gonna come down! Ah!
Right, the usual suspects always come out of the woodwork and have something to say along the lines of, "Ooh, it's gonna get much worse," and "Ooh, yeah, I told you so," and "Ooh, the inflation and the collapse and the implosion and the blah blah blah. And as far as I know, there has not been any implosion yet, or of any.
Well, and then as far as
other than the bank shutdown and this and that, which was bureaucratic move, but yeah, we'll get into that.
Well, and then let's talk about before we get into the details. Let's kind of rehash kind of the MMT like as fast as we can for someone who might just jump into this going, what are these guys talking about? Right? We're looking at this through the MMT lens, the modern monetary theory lens, which we believe accurately denotes that the government is the issuer of the currency. It gives license to the banking system to create money out of nothing. That's what a loan is. It creates money out of nothing. And that a lot of the regulations that are either, via Congress or via the Federal Reserve or whatever regulating authority is regulating that bank are very, very arbitrary. For example, the reserve requirements, right? If you listen to, for example, the Austrian or the Peter Schiffs or the Alex Jones or the whoever, you'll often come away with a fractional reserve theory of the banking system, which says, okay, there's this money multiplier effect where if they have $10 in the bank, they can lend out $100, right? That's the fractional reserve banking system. And depending on whatever the reserve rate is, that affects their multiplier. So if you reduce the reserve rate, they could get more and more strained in their lending. Well, that's actually not the case at all. The bank makes the loan first, it creates the money out of nothing, and if there's a reserve requirement, it turns around and finds those reserves later, and those reserves are always available.
Sorry to interrupt you. We will get into that now in the tutorial that I've kind of prepared in my mind. So all of those things we will get into.
Okay, well, let me wrap this up by saying a lot of what the doomsayers use to say, okay, this is how the banking system works, and this is proof of, what I'm saying is true. A lot of it is arbitrary bullshit regulation, like the reserve requirement, which does nothing other than be an annoyance to the banks.
It is like a tax on the banks, essentially.
Yes, because they have to hold on onto money that they otherwise could just go off and invest smartly with. So with that, Nima, I'm going to hand it over to you. Let's get into what actually happened at Silicon Valley Bank. Did it have to happen, and is it indicative of what's going to happen through the rest of the banking system?
Right. So I think, so let's start with just a very simple intro into banking, like a tutorial of how banking works and what a bank does in the course, throughout the course of being a bank, right? And then we will get to SVB's situation, the snapshot of their balance sheet. Basically, what we're going to be going through now is kind of like going through the history of SVB in a compressed time scale. So I'm going to share my screen because I have something prepared here. Share. Okay. So actually, I will just start with a balance sheet model, okay? I'm gonna utilize sort of corporate bookkeeping jargon, lingo methods, and if that's something that's completely alien to the viewer, then just bear with me. It's not, necessarily, it's not that complicated.
I'll try to act like an uninitiated, because I kind of am, so I can ask stupid questions that
exactly
maybe somebody else might be thinking of.
Exactly. So
we got step one here, right?
Yeah. So
set up a bank.
So step one, right? So Nima wants to start his own bank. Okay, I want to start my own bank. I want to found a bank. What is the assets and liabilities thing? So this is a balance sheet that every corporation compiles every quarter or so, which tells the owners, the government, everyone interested, all the stakeholders, what is the stuff that the company owns, in other words, the assets, which shows up on the left-hand side, and how was the stuff they own funded, which is on the liabilities side. Okay?
And this is double entry bookkeeping.
Entry bookkeeping.
Every asset has a liability attached to it somewhere.
Exactly. So let's say I start a bank now. Actually, I think it's maybe more fun if I just start typing it up.
Do it
as I go. Let's see how that works. So step one, we have assets, liabilities. So Nima starts a bank, right? What do? I buy a building so I can have my bank for $100,000, and actually 100,000 building, and I funded it all out of my own savings. Okay, so we start with a building that I purchased for $100,000 of my own money,
which means the company owes you $100,000.
Yeah, which means I own all the assets in this business right now. I put in $100,000 and I bought a building where I can put my bank in, and that's it. Okay. Very simple. Obviously, in the real world, don't look at this as one building, but it would just represent all the fixed assets of a bank, right?
Right.
We start with nothing and we buy a building, and it's all funded out of my own pocket. So
Well,
it's
and then if you had $200,000, $100,000 went to the building, and then you stuck another $100,000 into the bank, that would show up here too.
yes.
Right.
But I'm not going to do that right now because I want to show people where the reserves come from and all that stuff.
Right.
So we're really just starting with a building, and I fund it out of my own money. And the
bank has $0 in its own bank account.
Correct. We get a bank account at the Fed at this point, right? We've complied with all the requirements, all the regulations, all that nonsense. So let's say we have a bank account we have a reserve account now with the Fed. That's at $0, right? We have a reserve account at the Fed, fresh account, starting from scratch. The Fed is, okay, here you go. Here's your account with us. So just as you and I have checking accounts at Citibank or wherever, Citibank has a checking account at the Federal Reserve Bank, and that's their reserve account. Okay.
And only banks are able to do that. You and I aren't able to do that, right? Okay.
Only banks are able to have a reserve account, basically, a checking account at the Fed. And at the end of the day, all assets always have to match all the liabilities. So that's why it's double entry bookkeeping. We're at 100,000 on the left side, and that's the building. On the right hand side, 100,000, it's out of equity, so I funded it. Okay, now step 2. What do banks do? Banks make loans. Okay, that's how they make a profit. So we still have a $100,000 building here, but now let's say I make a $500,000 loan. Okay, so Dylan wants to expand his business and build a factory, and he's a good credit risk. We go through underwriting, go through all that shebang, and we make a loan to Dylan, which means basically we sign a contract. Dylan, you now owe us $500,000 over the next
10 years.
10 years, and you pay us 10% interest, let's say, every year. Okay, so we closed the loan at $500,000 loan to Dylan. I'm gonna write Dylan here. And on the right hand side, once again, we still have our $100,000 equity. And now, how do we fund this loan? Well, we mark up Dylan's checking account deposit. Right, Dylan, now we have $500,000 checking account. Dylan.
Now, just so I'm clear on this, so the $500,000 asset of a loan, or the $500,000 loan is an asset because that's $500,000 that I owe you.
Correct.
The $500,000 is also a liability because that's the $500,000 I can walk to the bank and go, okay, I need some of my $500,000 now.
Immediately available money. Exactly.
Right.
That's what we owe you now. In exchange for your guarantee to pay us $500,000 over 10 years at 10% interest, we owe you $500,000 in immediately available money.
Well, and then more than likely, just to make this a little bit more realistic, if I bought a business or I bought a factory or something, that $500,000 would never even hit my bank account because it would be a part of the closing and immediately go to whoever I was buying the place from.
Yeah, I think it's possible.
I mean, that's what I did recently.
Okay. Right. So depending on the kind of arrangement, the type of loan you get, it could be a personal, or it could be just a business loan or line of credit, in which case it would just basically be marking up your bank account with $500,000 that we basically, your statement now says you have $500,000 in your checking account. Okay.
And then this creates the money out of nothing.
Exactly. At this point,
this is the magic wand that goes, woo, $500,000 now exists. It didn't exist before.
Exactly. So step 1 is set up bank. Step 2 is make loan. Now, step 3, Dylan buys factory.
Oh, I see. You're breaking this into two.
Yeah.
I see. Yeah.
So Dylan buys the factory. Maybe it's nicer if I make these bold. Maybe not, but I'll still do it. Okay. Once again, we have our assets, liabilities. So what happens now? Okay, we still have our $100,000 building, our fixed assets. We still have the $500,000 loan, Dylan 10%. We still have 100,000 in equity. But now what happens? So Dylan
took all the money.
Well, yeah, Dylan takes the Nima Bank checkbook, writes a check to Bob, who sells him a factory, and Bob is banking with Bank of America. Okay, so Bob presents the $500,000 check to his bank, Bank of America, and Bank of America is going to present this check to the Federal Reserve and say, here, bank so-and-so, Nima Bank owes us $500,000 in reserves. So now that bank will hit our so the Federal Reserve will deduct $500,000 from our reserve account and mark up Bob's bank with $500,000, but we have no $500,000. So we need to borrow $500,000 from the Fed. So now we have a $500,000 Fed loan. Let's say we pay them about 5% for that loan.
And then that 5%, is that the interest rate that the Fed is always talking about? We raised rates 75 points or dropped them 25 points or whatever. That's that interest rate?
It's kind of like that rate. It's a little higher than that rate because this is like the most extreme example where I go directly to the Fed.
Okay. You don't borrow this. It doesn't have to happen this way.
Right, because the bank, the discount rate that they talk about is the interbank lending rate, which is me borrowing reserves from another bank. Okay, and we'll get there shortly.
Okay.
I just want to.
But I mean, this is the way it, like, fundamentally, all of the things not working, this is the way it works.
Yeah, if we were to start from the very scratch, right, that says no other banks yet or whatever, then this is how it will work. And to understand the entire system, we could just multiply this entity here as many times as we want. We can have this bank, another bank, another bank. They all have this kind of balance sheet, and every individual too, by the way, right? Dylan has his $500,000 liability to us and a $500,000 checking account. So to Dylan, these two are reversed.
Right.
Sorry, these two are, his checking account is an asset, the liability is on the liability side. But all of these like neatly tie into one another. And
now
that's
sorry to interrupt, when the $500,000 Fed loan is taken, the reserve account still remains zero?
Well, yeah, because I mean technically the reserve account
is negative 500,000, right?
Negative 500,000. But then I borrow the reserves from the Fed to bring it back to zero, basically. So that's why there's a Fed loan of 500,000 and reserve.
Okay, so the reserve account has to be zero. Do I have that right, or should I just shut up and let you keep talking?
Well, it has to. Technically, this could be also considered an overdraft at the Fed, right?
Right.
Because it's my reserve account at the Fed, and I've borrowed $500,000 in reserves from them to pay that to cover my reserve account, basically. So technically, there'll be two steps. Right. First, it's the reserve account is minus 500,000. But I can't have that, right?
It can't be negative.
It can only be negative if I then promise to pay the Fed an interest rate for in exchange for them extending an overdraft on the reserve account.
And then also, I think this is important to point out, this is the arbitrage that the bank makes. This is how they make their money, right? They lend out at 10 and they borrow at 5.
Exactly.
And then the Fed makes the money out of nothing.
Exactly. The Fed creates this loan out of nothing, just as we created this checking account out of nothing, right? The Fed creates it. And now keep in mind, these numbers, like there are regulatory requirements. You can't just have one loan of 500,000 when all your assets, blah, blah, blah. I'm ignoring all of that because it doesn't matter. It doesn't change the fundamentals of the system fundamentally.
Well, and then this, looking at it this way, this also shows how the government, the Federal Reserve, is still the one fundamentally making the money here. Right? So creating the money out of nothing. So, okay, the bank gets to create the money out of nothing, but if it can't turn around and go to the Federal Reserve and create the money out of nothing over there, it can't actually make that loan.
Exactly.
Because that puts its reserve account negative.
Exactly. Except, like, we'll get to that. Now, I just want to point out, this is the easiest version of doing it. No bank really does this, right? No bank really goes to the Fed then immediately to borrow this money. But this is the lender of last resort option that's always available to every bank, right? They could go to the Fed, borrow $500,000. However, what they're going to do now is, because they don't like to pay 5% to the Fed, they can instead go to... So now we go to step 4. We replace that Fed loan with a reserve loan from another bank. Okay, so we bank borrows reserves from another bank. That's our step 4. So once again, we have our assets. We have a $100,000 building. We still have our $500,000 loan as an asset. Loan, billion, 10%. And we still have our $100,000 equity. And now we just get a $500,000 reserve loan. Loan from another bank. And let's say we pay 4.5% for that one, right?
So we just saved 0.5%.
Exactly. So now we've improved our profit margin a little bit by doing this. In reality, most of the time, the bank will do this one right away if they're short reserves, right? Now, what's even better than
depositors?
Exactly. What's even better than paying 4.5% to another bank is to get depositors. So let's do this in the next step. Step 5, bank attracts deposits. So we still have, assets, liabilities. So now we still have 100. I'll just copy these.
Yeah, I was waiting for you to do that.
And this one we can copy over to. So now we get a $500,000 deposit, a savings deposit, let's say.
Let's say it's from Bob, who got the money for the factory, who decided to change banks.
Or maybe it's from Dylan, who just made major bank from his factory project. And now he brings the money back. So we attract a savings deposit of $500,000 on which we only pay 3.5%.
And that's the rate they offer the customer to attract the deposit.
Exactly.
Right.
And that's why they do that. So they cut their costs of funds, basically. Right. So now we went from a Fed loan of 5% to a savings deposit of 3.5%. These numbers are not exactly representative of the rates that are offered right now, but they are kind of in the ballpark.
This is making things a lot clearer for me too, because this is also clear why, if the Federal Reserve raises or drops rates, why the rates that we get as customers raise or drop.
Exactly, because banks compete for these deposits, right? So the banks look at each other and see, okay, how much are these guys paying, and how much are those guys paying? So what kind of rates do I have to offer in order to attract this cheaper? And
as long as it can never go higher than step 4, because if it went higher than step 4, you would just go to the interbank lending market because that's cheaper, right?
Exactly. And now the thing is, what we haven't looked at yet, what I'm going to do now is, so every 2 weeks or so, the Federal Reserve requires that the banks have about 10% in reserves of deposit liabilities. So for all the money that we have in deposits, like savings deposits here in this case, we have to have 10% of that in reserves. And how much reserves do we have right now? Well, we still have 0. We're still at 0 on our account, right? So now, what do? We have to get $50,000 in reserves, right? Because we're offering $500,000 in savings deposits.
Mm-hmm.
So how do we do that? Well, we get a $50,000.
Well, we could use any of the 3 previous steps, right?
Exactly. We could do any of these things. We can attract more deposits too.
Mm-hmm.
So what we could do, for example, we could say is we attract $50,000. Oh, sorry, but that would then in turn. So I'll make it easier. I'll just say we borrow $50,000 from another bank. Okay.
Okay.
So I'm going to insert here. Oh, sorry. Insert. So we borrow $50,000. Sorry. So we recognize $50,000 in new reserves. And how do we get those reserves? We borrow them on the interbank lending market. And we pay about, what did we say, 4.5% on that.
Mm-hmm. And so now a reserve account is now $50,000?
Our reserve account is now at $50,000, exactly. Reserve account, 50,000. And also now our asset base is 650,000. And our liabilities of 650,000 as well. 500, 600, 650. So now we have a bank with $500,000 worth of loans, 100,000 fixed assets, $50,000 just sitting there in reserves. Now, the reserves earn us some interest rate or a low interest rate. Let's say it's what did I say here in my previous example? Like let's say we earn about 4% on these reserves. But we are allowed to, as a bank, we can put these reserves into treasury securities, like treasury bills, treasury bonds, and maybe some agency securities or whatever. So we're gonna. Take a step back. Right now we have $50,000 in reserves, and that's the minimum. So we're required to hold these reserves, right?
So those have to be held, and we do nothing with.
Exactly, those have to be held.
So that's 0%.
Well, yeah, we're borrowing for 4.5%, and we're getting 4% on these in my example right now.
But
so we're losing a little bit of money.
Why are we getting 4% for them?
Because the Fed has started paying reserves.
Oh, okay.
Yeah,
and the Fed's just paying you money for the reserves. Got it.
Right.
Okay.
Before that, they didn't used to do that. So then people would just but it doesn't necessarily fundamentally change the economics of it all. But yeah, it does punish you a little less if you're earning reserves. So if you're earning money on the reserves, it's obviously better than earning no money on the reserves. But even so, we had to borrow $50,000 from another bank. We were paying 4.5, and on this one we're paying 4%. So we're losing a little bit of money on this, but we have to do it for regulatory reasons. We have to have this kind of reserve.
Yeah, and that's you hit the nail on the head. That's a regulatory, arbitrary thing that could just literally go away, like it did during COVID, like it is in Canada. It could just be zero, and then that's fine. It's completely arbitrary.
Exactly. So now, let's say we attract some more deposits, like let's do a step 6 here. And this is actually kind of realistic because during the lockdowns, the government stepped in and marked up people's bank accounts, basically. If you know MMT, that's how this works, right? So a lot of people got their bank accounts marked up, and that we will now see how this has affected the banks, basically. So we're now going to simulate the cash, the avalanche of cash that happened during the lockdowns here in step 6. Okay, so, and we'll just assume they're checking deposits for the sake of simplicity. And checking deposits, the good thing about a checking deposit from the bank's perspective is there's no interest that they're paying on those. So those are kind of like the cheapest source of funding, but they're also, they come and go all the time, right? But let's say, what are we doing here now? On the right-hand side, I'm just going to copy these things. But also, let's say we're getting something like $500,000 in checking deposits now. So 500,000 people to transfer money from elsewhere to this bank, to our bank.
So now our reserve account is $550,000.
Exactly.
And now we have $500,000 that we don't have to just keep because of a regulatory reason.
Exactly. So we are allowed to. So we have 550 in reserves here. So now we have a total asset base of 1.15 million. And 1.5 million here as well. 500, 600. Yeah. So we have $550,000 sitting in reserves. Now we only need 50,000. What do we do with the remaining 50,000? We'll invest that in treasury securities. Okay. So we, step 7, invest.
And then Nima, just a reminder, I'm kicking myself for pick of the time. I've got a 1 o'clock meeting.
Right.
We're 15 minutes out, so
we'll see.
Maybe we break this into 2 pieces.
Yeah, we'll see. I think this part we're almost done with, so we'll see. So now, instead of just having 550, all the 550 sitting in reserves, we'll diversify that a little bit. We leave 50,000. Sorry, because now our total deposits have gone to 500,000, 1 million. We now have to have $100,000 in reserves because that's 10%, right? So we have to leave $100,000 in the reserves. But we can invest $450,000 in treasuries. Let's just say, for the simplicity, they pay 6%.
And I really see how the game here is really just minor adjustments in interest rates.
Exactly. It's cost optimization, right? We still have the loan to Dylan sitting here. Oops, what did I do? And then on the liability side, basically nothing changes. Everything's the same. We've just done some shoveling around on the asset side in this step.
Right, which gives us a better interest rate. I
Yeah,
mean,
slightly more income.
which is, out of all the stuff coming in and all the stuff going out, a little bit more comes in than is going out now.
Yeah. So what you could do technically, we can do is we can multiply 6% of 450,000, 10% of 500,000. You add all these up together, and you come up with an annual profit based on this current constellation of assets, right? So that is what the bank is worth to the investing world, to the shareholders, etc. Is how much subscription revenue do we earn? Basically, it's like every time you make a new loan, you have signed on a new subscriber who pays you, like in this case, pays you $50,000 a year, right? So this is where we're at now. We have 100,000 reserves, 450,000 is sitting in treasuries. We have our $500,000, $100,000 building, etc. We've attracted checking deposits by offering merchant services or whatever. So obviously, as these checks get written out, our reserve account gets drawn down. Then we need to sell treasuries or borrow reserves from another bank or from the Fed. Or whatever we do, we have to shovel things around if we experience a deposit drain of any kind. So this is the situation. This is like the life cycle of your average bank. This is what they do, and this is where we are now. So now we can have a look at where Silicon Valley Bank stood at the end of 2022. With all this here in mind, right?
Oh, yeah, so let's do it.
Replace this with actual numbers, and I have these down here. Based the best of my ability to put these numbers together based on what I read in Wikipedia and other places. SVB pre-collapse had about 17. This is just my guess because they never really say exactly how much reserves they had, but they should have had about 17 billion sitting in reserves. And that also happens to be about 10% of the deposits that they had, which the deposit number, I know for a fact that this number is correct because this number is available.
Yeah, that's like a government available number right there, right?
Yeah. Like all of this. So basically, these two are what I had listed in our thing here under treasuries. Just they have a
two different types of They have a short term that they call marketable securities and a long term securities account. And they had $74 billion in loans and a total asset base of $209 billion. Okay. Now the thing is, what stands out here is why is there so much treasury, like 90 billion treasuries and only 74 billion in loans? Why is that the case? Is that normal for banks to be doing that? And based on what I found, it's not necessarily normal. It is a symptom of the cash infusion that has happened during the lockdown phase. And I actually came across an article that we can have a brief look at here in the New York Times. I believe from, let's see, this was August 2021. So this was basically after all the cash infusion, all of that had happened, and in some states or in some cases was still going on. Banks are binging on bonds, but not because they want to. Banks are awash in deposits, and their customers are taking out fewer loans. So they have little choice but to buy up government debt, even if it means skimpy profits. So basically, I'm not going to read through all of this now, but well, I mean, I think the title, that subheadline said everything.
Exactly. It sums it all up, basically, right?
Yeah.
This is what happened. So because normally, if there's people that I can loan more money to that are good investments, and I'll do that, right? And I'll up the 74 billion to 80, 90, 100, 200 billion, however much I can loan out. And so what will then happen is, as those checks are written, as we saw earlier, a lot of these reserves will clear out from our account into other bank accounts. But the money we earn on loans is more money than we earn on the treasury bonds. So if this whole account gets drawn down here in exchange for building up a loan portfolio, that is good. That's what a bank wants, right?
Small side note here. Silicon Valley Bank told me no to the loan for my business acquisition. They were just like, yeah, we just do tech. Go away.
Yeah. Well, and also
not that the amount that I borrowed would have changed this very much, but if this is a problem, fucking give me a loan.
what happened during the lockdowns was that people were given a lot of cash from the government and had less demand for loans. So the article that I just showed also bears it out a little bit, that people didn't have much demand for loans. So this was a problem for banks during this whole period, right?
So that they have a ton of deposits, not enough loans. Where are we going to stick the money? We might as well stick it into Treasury securities because we'll get a little bit more interest and reserves.
Exactly, and that's what they did throughout 2022, which was the worst time to be doing this. They put a lot of money in long-term Treasury bonds in their reserve account.
And this is before the rates started going up, right?
Right. It was kind of like during. However, still the rates kept on accelerating beyond expectations, right? So they ended up end of 2022, they're sitting in this 91 billion Treasury bonds portfolio, and we can have a look at Wikipedia now. Collapse of Silicon Valley. So the story of Silicon Valley Bank, basically, I'll just read it real quick. Seeking higher investment returns in 2021, SVB began shifting its marketable securities portfolio from short-term to long-term Treasury bonds. The market value of these bonds decreased significantly through 22 and into 23 as the Federal Reserve raised interest rates to curb an inflation surge, causing unrealized losses in the portfolio. So basically, if we go back to our model here, my $450,000 treasuries now suddenly we're only worth like 400,000, right? So
now we're off by 50 grand.
Exactly, 50. So now we have 400,000. So now we have 1.1 million here, and same here. And how does this affect? Well, now this is a loss. Okay, this 50,000 is a loss. Where does that show up here? Well, it cuts into our equity. So now this is really not a good thing. Okay, what happened with the losses in this Treasury bonds portfolio, because Treasury rates were raised so quickly. Okay, I'll just keep reading on. Higher interest rates also raised borrowing costs throughout the economy, and some Silicon Valley Bank clients start pulling out money to meet their liquidity needs. To raise cash to pay withdrawals by its depositors, SVB announced on Wednesday, March, it had sold over 21 billion worth of securities, borrowed 15 billion, and would hold an emergency sale of some of its treasury stock to raise 2.25 billion. Okay, so now what happened here? These deposits started going out
because they had to make interest payments.
Yeah, for all kinds of, or people just moved their money to other banks, or people just pulled out money. A lot of money just went to big banks, and some of the banks that were paid were like First Republican banks like that. Those were the banks that were paid out of Silicon Valley Bank accounts. And so these deposits started clearing away from SVB. So that means that draws down the reserve account here, right? So let's say the deposits drop to 300,000, so 200,000 out. So now we're down here 100,000, negative 100,000. So how do we cover that negative 100,000? We have to sell some treasuries. Okay, so we draw down our treasury account to 200,000, and our reserves. So whatever happens here, I mean, they have to end up being adjusted based on the reserve requirements, etc. I'm just trying to illustrate here how this reserve drain has forced the bank to start selling their treasury securities. And these treasuries, through 2022, treasury values dropped by like 20, 30, 40% or so for long-term treasury holdings, because the rates went up so drastically from 1% to now 3.7% or so. So what happened here is that the bank had to realize some losses. Actually, I'll go back to the article where it says here, unrealized losses, blah, blah, blah. The announcement coupled with warnings from prominent caused a bank run. So people start pulling out deposits, okay? On the morning of March 10th, the California Department of Financial Protection and Innovation seized SVB, placed under receivership with the FDIC. So this was on March 10th. An additional 100 billion were expected to be withdrawn during Friday. And about 89% of the bank's deposit liabilities exceeded the maximum insured by the FDIC. I mean, they point that out as if it's something unusual. I think this is not necessarily uncommon for banks.
I don't think so.
For banks to have so many deposits that are uninsured. I personally, I don't understand why. I don't understand why people just put their money in a treasury market, in a money market account that only invests in treasuries, because that's what I do. And then you never have to deal with any of this. You can write checks against it. You have no limits on withdrawals and deposits, etc. But okay, whatever. I want to skip to a section.
And I'm down to the countdown clock here.
I see. At that point, it's mark-to-market unrealized losses exceed 15 billion. Okay, this is the crucial point. So about 15 billion in losses on their treasury holdings is what they had realized, and that is understandably, that's not good. That's not good news for a bank with.
They lost, but they're losing money, right?
Right. So because their annual revenue, 2022, for example, was $6 billion. Okay, so $15 billion in treasury losses would probably put them at a loss at this point for this year. Mm-hmm. Not good, but also not
enough to kill a bank.
Exactly, not a disaster. And I guess we're down to.
How about this? I got an idea. I don't know. I don't think there's too many people watching us right now. Let's follow this up on a local recording, and then we'll glue them together in the editing.
Yeah, sounds good.
You like that idea? Because this is my fault for sleeping in because I'm jet lagged. We were supposed to start earlier, but this is absolutely fascinating, and I now have a much clearer idea of the banking system, and I think everybody should have it. And I'd like to discuss more about the
what happened here.
Well, what happened here, and what are the actual implications of that throughout the banking system, and just another example of if we really understand how this works, none of this shit has to happen.
Right. I mean, I think what's important to understand here is that, in the case of the 2008 financial crisis, the problem was here. This thing,
the loans were bad.
The loans were bad. So we had to start marking down the loans from 500 to 400 to 300, 200. Huge losses that ate up all our equity for assets that were our strategic business and what we're supposed to be doing. But what happened here was some losses on cash management resources that were somewhat poorly managed one time, So that's kind of like the difference that I see.
And it wasn't negligence. It wasn't their fault that the Fed raised rates so precipitously, right?
I mean, I think they did not need to put this money in these long-term treasuries, what it comes down. They could have left it in short-term treasuries. It didn't look good in the moment when they were doing it, obviously, but turns out they would have fared much better if they had just left them sitting in short-term securities. Mm-hmm. But, so this is a one-time loss, not good. I think a lot of banks will end up suffering this type of loss because of the systemic things that happen, because of the deposit flush.
Okay, we're back. We had a break there because I had to run and do stuff, and now we're back to analyze what Nima just went over and what this means in the broader scheme of things. So, Nima, do you mind pulling up that data, or data is not the right word, the spreadsheet that you had from before, so we can go off of that?
Yeah. So this is where we ended our simulation.
And zoom in as much as you can so it takes up as much of the screen as possible.
Okay, let's see. View, zoom. Okay, that should be.
There we go. Okay, so we were talking about, here's this double entry bookkeeping that the bank has to go by, and the bank plays this game of everything that it does is either an interest rate coming out of its pocket or an interest rate going into its pocket.
Yeah.
And the game of the bank is to make as much money as possible with these various interest rates. Silicon Valley Bank runs into the problem that it had invested all this extra money in treasuries because it had all this money on the books, presumably from the fact from all the COVID money that got handed out that they couldn't get out enough loans to make up for this COVID money. So it turned around and buy treasuries, long-term treasuries specifically, which aren't necessarily a bad idea, but then the Federal Reserve turns around and hikes up interest rates so much that those long-term treasuries lose a ton of value, which now screws up its reserve requirement ratio.
Well, right? It doesn't necessarily screw up the reserve requirements ratio because the reserves remain the reserves, right? They are still there. But what it does do is it produces a noticeable loss on the books of the bank. So in this case, if I remember correctly, that we went through the Wikipedia on it, there seems to have been about a $15 billion loss in the treasury holdings.
Just from this rate hike, right?
Well, a loss realized in their sales, in their early 2023 sales of treasury securities. So yeah, the reason why treasuries dropped so much in value in 2022, obviously, is the fact that the Federal Reserve started hiking rates like crazy, basically in 2022, in order to fight the inflation.
Inflation, yes.
Which, as we've discussed many times before, raising rates doesn't fight inflation. It actually
contributes to.
It actually contributes to it more likely, if anything, and also it screws up the bank's business to some extent. We've discussed it before too. What happened in the 80s with the savings and loan crisis after the Volcker experiment? A lot of banks started running into trouble on the funding side, which is on their asset side, because their treasury holdings, with the savings and loan, they ran into problems on their liability sides because the deposit rate had gone up so much to like 18% that it was higher than some of the longer-term bonds that they had, longer-term loans that they had made. In this case, what happened with the Silicon Valley Bank is they bought about 90. They had, but I guess when all was said and done, COVID, a reserve flood comes in, and also a lot of people get cash infusions, so not much demand for credit. So not a lot of demand for loans. And
can I expand on that briefly? Because I personally got a PPP loan, so I on the other side of it, I have an idea of what it's like. So basically, you had to go to a bank and you got a PPP loan, and the bank generated the loan, like a typical banking world would do, which at that moment put it on their balance sheet as we had put here. It would be under the loan category where there's an asset and a liability, right? But then the government turned around and forgave the loans, meaning
right.
if I have this right, where there was a liability and an asset on the balance sheet because there was the loan that it had out to me and the loan that was owed back to the bank. What was owed back to the bank evaporates, so now it's just it goes over. It becomes a reserve, essentially. Do I have that right?
Yeah, I mean, it becomes a deposit.
Yeah, I'm sorry. Thank you. That's the right word. It becomes a deposit. Now, there's still an asset and a liability, right? The asset is they have the deposit, and the liability is they have to give it to me if I ask for it. But it's a different asset liability match than had it been a loan.
Well, yeah. What happens here? What we discussed in our previous session, step 6. It's basically just a bunch of reserves coming in, a bunch of deposits coming in to the bank. Not because the bank is. Not because the loan was made by the bank or by some other bank, but rather just because people's bank accounts were marked up by the government. That's the end effect of it all.
Correct. Right. And then this puts the banks, and we're looking at Silicon Valley Bank specifically here, where they have so many deposits, they can't get loans out fast enough to get that 10% ratio or whatever they're the optimal ratio. What's that?
Well, their loan making capability has nothing to do with their reserve.
Yeah, I know that it has nothing to do with the reserve, but they want to get more loans out, and because if they've got $10 in reserves and $100 out in loans, and there's a 10% reserve requirement, they're optimized, right?
Mm-hmm.
But now they've got $100 out in loans and $70 in reserves, and they're going, shit, we got all this money sitting here not doing anything.
Yeah.
Let's buy some treasury bonds and get a return on this money sitting here.
Right. So the point is just that in our simulation here, step 6, we attract a bunch of deposits after our other activities here, after making loans and borrowing reserves from other banks and attracting deposits. That's the normal operations of a bank, normal business operations. We got here to the point where they attracted even more deposits. So now we have 500,000 checking, $550,000 sitting in the reserves, but no ability to make more loans because there was no demand for loans in the private sector.
Right.
At least not for good bank loans. There was the PPP and all that, but that doesn't count because that wasn't really a bank.
That was just a cash infusion.
It was a cash infusion. Yeah. It was not a loan that was profitable to the bank or to anyone. It was literally just cash infused into the private sector. There may have been some machinations of where, the banks were the agents that would implement the lending of these loans. But at the end of the day, it's not a profitable loan for the bank.
Correct.
It can just be removed from the books with some conditions, I guess, back then. If you continue to pay your employees and all that stuff, you were basically, the loan was forgiven completely.
So in a sense, and I don't necessarily say that this is coordinated because we got different branches of government operating independently here, but in a sense, the government kind of set the banks up for this problem, which is, okay, we're going to inject a bunch of money, so you got to turn around and do something with it, for example, buy treasury bonds, and then we're going to hike the interest rates that make those treasury bonds not worth that much.
Right.
But it's not that big of a problem like you want to talk about, right?
Yeah, I mean, it wasn't very nice of the government or of the Fed to raise the rates so quickly. Like, it's really nothing beyond sabotage of the banking system, if you will. There's no other purpose that what they did has served other than for the banks, securities holdings to deteriorate, as we've seen in the case of the SVB bank. And one way to prevent that from happening would have been to not buy long-term treasuries on the part of the bank, right? But then they would have had to keep the bank sitting in short-term treasury bills, which were paying next to nothing. However, ironically, throughout 2022, these short-term instruments started paying more than long-term treasury securities, right?
So Silicon Valley Bank just made a really bad bet, is what they did.
Yeah, I mean, from their standpoint, it was probably not really a bet. It was just prudent reserve management.
Right.
As they looked at it.
They didn't do any. They weren't. This isn't neglectful.
Right. They weren't gambling.
They weren't gambling. This wasn't a bad idea at the time.
Right. Although I do think that this may be an instructive case study for banks moving forward.
Right.
I mean, I don't know what they do behind closed doors in their boardrooms, but I think this will change this kind of practice, or at least banks will be much more apprehensive in the future to put so much money in long-term treasuries and then also, more importantly, not hedge appropriately against a scenario where these assets decline in value and decline precipitously, because 2022 really was a lousy year for treasury investors, if you will. Their prices came down big time. So $15 billion loss is not a nice thing. It totally sucks because as we saw here, it's like 16 billion in equity, so the bank would have to probably attract some more equity to fulfill regulatory requirements. They would probably have to maybe sell some assets, maybe borrow some reserves, go through a bit of a painful period of announcing these losses and their stock prices coming down, shareholders being wiped out, etc. But was not really a reason to shut down the bank and hand it over to the FDIC. And I think that's
the interesting part of the conversation now, isn't
yeah,
it?
that's what we can get into next. Is now I found this document, which I'm just going to post because I have it on my other computer as well. So let me pull that one up. Where's that? Okay. Okay, I'm gonna pull it up from our Telegram convo.
Did you watch that video on the flags yet? The state flags?
Not yet, no.
Dude, fucking hilarious. So, but sorry, I'm getting you distracted. Back on
Yeah.
this letter.
So yeah, so what happened? If we go back to, let me also pull up the Wikipedia on that. Collapse of Silicon Valley Bank. Losses, instability, receivership, blah, blah, blah. Okay, so on the morning of March 10th, examiners from the Federal Reserve and the FDIC arrived at the offices of SVB to assess the company's finances. Several hours later, the California Department of Financial Protection and Innovation issued an order taking possession of SVB.
That's a big jump. That's a big leap. Hey, we're coming in to check things out, and then boom, done.
Well, yeah,
boom,
it says here
done.
citing inadequate liquidity and insolvency. Okay, so inadequate liquidity is obviously accurate. That's what happened here because they weren't able to find enough reserves for whatever reason to, by the end of the day, balance out their books. Because
important emphasis there, end of the day.
Right.
So, it's not like this is a prolonged issue. It's like someone's watching their watch going, time's up. You're out.
Right. Well, what happened was because of all this panic that was being instigated, people started withdrawing their deposits like crazy. Mm-hmm. And that, if we go back to our model here, that leads to this number here, the deposits declining. And what that causes in turn, and I've written down here, about 42 billion was drained of this when it was all said and done. So then that's obviously more than they have in reserves. However, they also talked about they've raised something, they've borrowed like I think 15 million.
Billion, you mean?
Sorry, yeah, billion. 24. So I added these numbers together, and it seems like they were just short. You know, here you can actually see 41.75 billion is what they were able to
so they're
raise.
They're short $250 million when we're talking about hundreds of billions. Or
right.
Billions. Yeah.
Right. So the reserve drain, etc., that's happening. Basically, the deposit drain just means that they need to borrow some reserves from other banks temporarily, as they're supposed to do, or from the Federal Reserve.
And they were still a quarter short.
Right. So they were. I mean, I'm coming up. These are very rough numbers, so I'm actually surprised that it's coming close. But they weren't. They were like a couple of 100 million short. And I'm going to go back here to this Wikipedia article.
Zoom in on that a little bit, please.
Okay.
A little more. Yeah, it's better.
Yeah. So instability. Okay, I was looking at receivership. Several hours later, the California Department. So let's see what this order here says. Okay.
And zoom in on this a lot.
Yeah.
If you can, get rid of that thing on the left. You should be able to close out the page view, I think.
Okay.
Yeah.
So the Commissioner of Financial Protection and Innovation finds Silicon Valley Bank is and was at all times mentioned in these findings of fact, a corporation organized, blah, blah, blah. Liquidity and insolvency. On March 8th, 2023, the bank announced a loss of approximately 1.8 billion from a sale of U.S. Treasuries and mortgage-backed securities. So that in and of itself is not really that bad, right? 1.8 billion.
Yeah, we're talking out of 170 billion in deposits or whatever. Yeah.
Right. And I mean, it said somewhere that here it had said somewhere here that they had unrealized losses of about 15 here. At that point in time, its mark-to-market unrealized losses exceeded 15 billion. Okay, but that's unrealized. So I don't know if then at one point they were forced to liquidate those holdings or whatever. But so anyway, so this is even worse, like even better looking at this point in time.
Just so we're clear, unrealized losses is to say, okay, I'm holding these treasuries. They're not as valuable yet, but I haven't actually sold them yet.
Right. Yeah. Right. I haven't sold them. I'm still earning interest on them.
I could hold on to them, and they could become more valuable tomorrow, and I'm fine.
Right. Right.
Yes.
From a sale of investors on March 8th, the bank's holding company announced it was conducting a capital raise. So that's just to explain. That's because the equity was reduced due to these losses, but actually 1.6 billion isn't really that bad. So there must have been some more. I'm guessing that's that 15 billion. But anyway, despite the bank being in sound financial condition prior to March 9th, investors and depositors reacted by initiating withdrawals of 42 billion in deposits from the bank on March 9th, causing a run on the bank. As of the close of business on March 9th, the bank had a negative cash balance of approximately 958 million. So about $1 billion in negative.
Which again is chump change compared to everything we're talking about here.
Yeah, I mean, it's
maybe not chump change, but it's small in comparison.
Right. It's it's a figure that'll show up in their year-end reporting, of course, noticeably. But it's not a disaster. It doesn't really seem like anyone didn't get paid by the bank at this point yet. But it's just that it's out of a technicality, I guess, the bank had a negative cash balance. I mean, this is not supposed to happen. The Federal Reserve was created to prevent this from happening. That's their only mission, if you will. If there's one thing the Fed's supposed to do, is to make sure that there's no liquidity issues with financially otherwise sound institutions that have assets on their books that are good assets.
Quickly, let's review this, which is to say, the purpose of the Federal Reserve is if at any case a bank runs into this situation, they could always turn around and walk up to the counter in the Federal Reserve and say, hey, I need $958 billion. Yeah. And the Federal Reserve always has it because they make the money out of nothing.
In fact, the fact that they had a negative cash balance, that in and of itself tells you that the Fed loaned them $958 million by the end of the day on the net.
Okay.
Right? So they had, in essence, it's a Fed loan. It's like borrowing reserves from the banks. But somehow this time, it was decided that that's bad. So we read on. Despite attempts from the bank with the assistance of regulators to transfer collateral from various sources, the bank did not meet its cash letter with the Federal Reserve. The precipitous deposit withdrawal has caused the bank to be incapable of paying its obligations as they come due, and the bank's now insolvent. Now they're not stating how or why or any evidence that they can't pay its obligations. They're just declaring.
Well, and then look at the sentence before this, right? And I guess this talks to a greater issue that we've discussed ad nauseum here. It says, despite attempts from the bank with the assistance of regulators to transfer collateral from various sources, the bank did not meet its cash letter with the Federal Reserve. That cash letter is an arbitrary fucking regulation, right?
Yeah.
So I mean, there's this big scramble of like, what are we gonna do? The sky's falling, because of just some arbitrary bullshit from the Federal Reserve.
Right. And the Fed seems to have been okay with it. I mean, they were able to extend this overdraft of 958 billion. Nobody's screaming, my money is gone. Nobody's got any issues at this point.
Right.
Other than the regulators.
And then so I have to eat it sounds like I got to eat my words from previously. So you mentioned the only reason the Fed was put into existence is to provide a loan for that. It sounds like they did provide the loan for it, and then this California attorney or general, whatever the heck he is, still closed the bank.
Exactly. So yeah, we'll read on here.
Okay.
Despite attempts from the bank, so we just declare them. So okay, there is a liquidity issue here, no doubt.
And who's not getting their money? Tell me who are the people that aren't getting their money? He doesn't.
Right. Well,
yeah.
In this case, it's only the Fed. The Fed doesn't need their money. So, it's despite attempts from the bank, the system's regulators to transfer collateral from various sources, the bank did not meet its cash letter. Okay. The precipitous deposit withdrawal has caused the bank to be incapable of paying its obligations as they come due, supposedly, and the bank is now the bank is now insolvent. I mean, that's a big statement to just like add in a side note at the end of that sentence. It's like, but how? Because illiquidity and insolvency are two different things. Illiquidity means you don't have enough immediately marketable assets to meet payment demands from
which the entire banking system is set up to have solutions to that, as we keep discussing. Yes.
So they had a liquidity issue, but they didn't have a solvency issue because, as we saw on the balance sheet, they have 74 billion in good loans. They still have all these assets here. Yeah, they declined in value. Okay, sure. Yeah, they incurred a big loss, but
that's not insolvency. That's not your bankrupt.
Exactly. And even after this 42 billion drain, I mean, they would have still had like 133 in deposits. So, I mean, but by the way, these are numbers that, to the best of my abilities to reconstruct based on the numbers available at that time, I came up with this. But I think it's pretty spot on. The assets certainly are correct at the time. So anyway, let's read on from this order taking possession here. Ultimate findings. On the basis of the findings of facts set forth above, the commissioner finds the bank's liquidity position is inadequate and it cannot reasonably be expected to pay its obligations as they come due. No reason why. The bank is insolvent.
No reason why.
The bank is conducting its business in an unsafe manner due to its present financial condition.
No argument why.
Right. On the basis of the ultimate findings, separately and cumulatively, it is ordered that the commissioner take possession of the property and business of the bank, and the commissioner hereby takes possession of the property and business of the bank. Okay, so this sounds like a coup d'etat, kind of.
Well, this is like, the socialist government gets in, and then they nationalize an industry. That's what this sounds like to me.
Right. So see, we find excuses to, at the end of the day, to come up with this conclusion that we've already predetermined. Right. So
I mean, let's summarize that. Bank experiences, maybe minor is not the right word, but major is not the right word either. Some mid-level irritation that the entire system is set up to be able to alleviate. And then 5 minutes later, the government of California says, you fucked up. You belong to us now.
Yeah, it's like, haha, you did a boo-boo there. We have to shut this whole thing down. People lose their jobs. People panic around the world. And the reason is unclear. It's we're just declaring this bank's insolvent and it has to be handed over. I mean, there would have been so much more graceful options of dealing with this. It almost seems like the people involved are puppets filling a role, and they're not really competent to do what they're supposed to do. They don't really know what they're doing in this.
Yeah, I mean, it sounds to me, and you and I were discussing this off the air, that there's some political payoff. I got no idea what it is, but based on what we just read and like the obvious, I mean, once you understand the numbers that we broke down, you understand exactly what the problem is, what solutions were available, and then the government of California turns around and does this. I mean, this sounds like they were ready to do it because somebody's gave orders to pay off somebody.
Right. I mean, SVB Bank is very involved with big tech, so maybe there's some string pulling that they're able to do because of controlling this bank, that they can browbeat big tech or small tech companies into submission. Now, what's also more, because a lot of people are talking about, the depositors were bailed out. There's a government bailout for the depositors. Well, not really, because
it's still their money. It didn't go anywhere.
Well, also, the money will be raised from selling the bank's assets, okay? It's not being raised. It's not coming from the government. It's coming from the liquidation of a portion of the bank's assets to meet these withdrawal demands.
Go ahead.
well, their 74 billion loan book is apparently pretty good because it's now being bid on. It's being auctioned off, and it's going to be bid on. And a lot of the usual suspects, BlackRock, etc., they're already licking their fingers for this loan portfolio. So yeah, that's just as an add-on, that there's not really a government bailout that happened here, as far as I can tell. It's more like restructuring and some selling off some assets to raise the money needed to make the depositors whole at the end of the day.
Well, and then this also alludes to something that we've said before, is that the whole idea that the FDIC only insures $250,000 of deposits, it's dumb. 100% of deposits should be insured everywhere.
Yes, it's what we've always said. There's no reason. $250,000 is an arbitrary number. It's being done in banks around the world and with differing amounts. Actually, in some countries, there's no limit. I remember during the 2008 financial crisis, the German government just lifted all. Yeah, they just said there's no insurance limit for depositors, and it was no issue. The government didn't have to go into debt, and no inflation happened or anything like that. I mean, yeah, the crisis was bad for other reasons because of how it was handled. But there's no reason, there's no structural, no systemic reason to have a limit on these deposits. But since we know that there is this limit on deposits, it becomes a political decision, right? It becomes a political decision to decide whether or not some depositors are made whole and others are not. And that's the reason, now I'm talking about some practical knowledge here, that's the reason why you should always have your cash position in a money market fund that only invests in treasury securities, or just straight up treasury bills. But with the money market account, a treasury money market account, it's like cash. You can write checks against it, and at the moment you're earning about 4.5% on that. It's like a checking account plus a better than savings account interest rate. There's very little reason to not have your cash balance in such an instrument.
Well, and then I wanted to add this because, one of the steps that led to having the reason for the government of California to have the reason to shut everything down was this bank run, right? Well, would that bank run have ever happened if everybody knew that 100% of deposits were insured?
No. Yes, no.
Right. So
is it this constant state of uncertainty about anything regarding banking that people in power can take advantage of?
Right. Well, and then so we've tripped over two completely fucking arbitrary obstacles to get here. Right. One is this reserve ratio, which is just this arbitrary thing that the Federal Reserve demands, and second is this FDIC insurance, which is an arbitrary number of $250,000 when it should be unlimited, as you mentioned. I mean, it just doesn't have to be this way. It's the point I'm trying to make, and it would be so simple to not have it be this way. Just somebody like pressing a button. It's not that way anymore. Bleep, and we'd be done. It's not complicated once you understand it. So, what I want to get into this next is, so now there's the impending next banking crisis, Nima. This is a foreshock of everything else that's about to happen, and then the whole system's coming down.
Right. It's that time of the year again for these people to. I've always told you have all these geniuses coming out now. Yeah, and see, I told you the system is unstable and blah blah, like very blanket statements. And do they ever do what we just did? Do they look at the books, look at the actual numbers, get a sense of what's going on? Well, of course not.
Maybe we could get a Peter Schiff cuckoo clock, where like twice a day, a cuckoo clock, once it hits a certain hour, it comes out and goes cuckoo, cuckoo. Instead, it'll be every day at 11 o'clock a.m. and p.m. It's Peter Schiff that comes out and goes, "It's all gonna crash! It's all gonna crash! It's all gonna crash!"
Right. So, but yeah, let's talk about some possible implications of this, obviously, because I think the banking data is now beginning to show that this was not a Silicon Valley Bank issue per se. This issue with having put so much money in treasuries. I mean, we even pulled up this article in our last session from the New York Times from August 2021, where they talk about banks who don't have much else to put their money in, don't have much else to invest in than treasury bonds because nobody wants to borrow money from them at the time, at least. So this is going to affect a few banks, I think, a few or a lot of banks, maybe. It's not an SVB issue, I don't think. Although, of course, how exactly the bank manages their reserves is up to them. But there are sort of practices and best practices that emerge. These people probably talk and exchange ideas. So a lot of banks probably have put some money in long-term treasury bonds. A lot of banks probably did not expect for the Fed to start raising so aggressively in 2022. I mean, nobody did, right? I mean, not nobody, but the vast majority of people could not foresee such an aggressive rate hike cycle as we saw suddenly emerging in 2022. We know that because the treasury bond rate at one point was in the lower 2% or so, and the short-term rates were even lower. They were, close to zero, and suddenly that all started flipping around. The short-term rates started coming up big time. So ironically, because these banks put all this money in treasury bonds seeking a higher return, right? So now what happened? They lost lots of value on those holdings, plus they're actually getting a lower return than you're currently getting with very short-term 3-month, 1-year treasury bills, which are currently paying somewhere around 4.5% even, whereas a treasury bond only pays 3.6%, 30-year treasury at the moment. So ironically, they would have actually, all their objectives would have been met, higher profitability and keeping their assets safe by just putting their money in, keeping that money in shorter-term securities. But they didn't do that. Now here we are. They have to mark down some of the assets on their books, and that's going to affect some banks. So I predict that a lot of banks this year, I mean, it's not necessarily even a prediction anymore, but because we saw the model with SVB.
You see the math, yeah.
A lot of banks are going to have to recognize some level of losses with their treasury holdings probably this year. It was worse with SVB because of this deposit drain. They had to quickly start selling their treasury bonds to have the reserves to meet the withdrawals, to meet the deposit withdrawals. So but I think that a lot of banks will start realizing some losses on their marketable and their long-term securities this year, and this will show up in their earnings as a one-time event this year or sometime end of last year. But it seems to be starting to happen now and not really at the end of last year. So does that mean that the banking system is in trouble? I don't think so. I think it means that bank stocks may be temporarily hurting from these bad news. However, on the flip side, there's so much terrible news already priced in, so much terrible expectations upon the future of the banking system now, that I think actually banks will probably surprise on the upside. I'm talking about US banks now. Other banks may be the same situation, because their loans are generally good. They don't really have issues with having made bad loans. Now, if that is an issue, if that starts to emerge, that'd be a different story.
That'd be in 2008, right? Where it's
exactly.
Like, the loans are bad. Shit.
Exactly. The loans that we make as our strategic business turn out to be crap, and now we have to mark those all down, and an entire industry that we were banking on big time, real estate, seems to have been overblown. People can't really pay back their mortgages, etc. So there was a big systemic strategic issue that these banks were facing. That issue too could have been dealt with, but that would have had to amount with government deficit spending, etc.
Well, as Warren Moser has pointed out to us, the easiest way would have just been a payroll tax holiday, and
exactly
everybody would have been fine. What
But
that
so-
would have
so, yeah.
required, like you said, that would have required Congress doing something as opposed to some bureaucrat in the Federal Reserve just not pressing a button or
Right.
pressing a button.
But yeah, that's just my assessment of the US banking system at the moment is that they are going to probably have a few nasty months of bad news. However, a lot of bad news is already priced in, and it doesn't affect them structurally, systemically, I don't think. It was a cash management issue, a liquidity issue at best at one day or so in the case of SVB. And it was used as an excuse for all these moves for dissolving the bank. And why did that happen? Well, we don't know what exactly went on behind the scenes.
Yeah.
Yeah.
Yeah. So I mean, you heard it here. Don't expect the banking system to crash due to this. This is not a sign.
Well,
this is not a sign of everything going down, but maybe it is a sign of. I mean, we got to look at this dude from California. What the fuck is going on that he just walks in and shuts everything down?
Right. This dude or this lady, I guess.
Yeah.
What was her name? Clotilde. That's such a German Renaissance literature name.
What is the name?
Clotilde. Clotilde Hewlett, Commissioner of Financial Protection and Innovation. But yeah, no, I think one more issue, obviously, with the SVB bank could be that they made a lot of loans to Silicon Valley startups. Silicon Valley startups were some of the greatest beneficiaries of the 2020, 2021 boom, 2022, maybe even still boom. Actually, 2022 started to crash, I think. But then also they are on the flip side, they're on the receiving end of the coming back down to earth of silicon, because everyone thought in 2020 and 2021 this is now the new normal. We're all gonna order food from McDonald's all day and sit in front of screens and do Zoom calls with each other and never go outside anymore, and ideally just, I guess, we lock ourselves into our coom pods with a straw as the only connection to the outside world and never touch anyone, never meet anyone again. I mean, these were scenarios that I think some people seriously thought were going to be the new normal. Mm-hmm. You know, you constantly. By the way, what's happened to the new normal now? Where's the new normal at today? There's like everyone
wants to go back to work. Like, get me outside, please.
Yeah, everyone's going back, and like this whole new normal was a trope that obviously benefited Silicon Valley and big tech, because big tech benefits when people don't go outside and meet IRL, right? Big tech benefits when people just use their products.
I like to use the tech term for meeting somebody in real life, IRL in real life.
Right. So yeah, so I mean, but anyway, I don't think that there's a serious systemic banking issue at hand. I mean, this, like I've said it like 5 times now, but yeah, I think this was a short-term blip.
Everybody calm down is what we're saying.
Right. Right. Well, the only thing is, you know, with these incompetent regulators, you never know what kind of story they're going to concoct next.
Actually, that's a good point. Where it's like there is a systemic problem here. Now that you point that out, and it's not the banking system; it's that the people running the banking system don't understand what they're doing, or they do understand what they're doing,
but they're captured,
and they're intentionally messing it up. Either way, it's not good.
Right.
Right. But hopefully what you learn here will help you understand how the banking system is actually working, and you can put your eyes on the right person, right? It's not the banking system that's screwing up here. It's the people in charge of watching over it, because everything was set up to prevent this from happening. The whole system had safety nets in place to prevent this from happening.
I mean, it's the Fed's mandate. Yeah, it's the Fed's mandate to prevent this from happening explicitly.
Yeah.
Right? And now they're like, oh, wow, what happened? The bank must have done a bad job. No, it's this like the whole inflation prevention mandate that came later. Actually, that was invented later on by incompetent people who don't know how banking works, because raising rates doesn't stop inflation. Dropping rates doesn't cause inflation. There's no empirical evidence for this. Professor Werner, the well-read author and portfolio manager and economist,
and advisor to governments and central banks all over the world. Yes,
he has stated this explicitly, that he made an empirical test, also even like how the banking system actually works and all that stuff. He did some pretty cool stuff, but there was no reason for this to happen other than somebody wanting to hand over the bank to different controllers, I guess. That would be one reason to make it happen. But in terms of good banking, there was no reason to get rid of this bank and solve this bank, per se.
Well, I don't have any more to say about it. Do you have any more to say about it, Ima?
No, I think that covers it.
Okay, well, you heard it here. Don't freak out about the banking situation unless there's some nefarious dude or woman like this person in California that just woke up one day and, like, for reasons that have no details whatsoever, this bank is now closed. Right?
Right.
That is an actual threat, as we just pointed out.
And also another threat to the economy moving forward is if they do start implementing austerity measures, we'll see how the numbers, how much deficit the government generates this month and next month. But if they start talking austerity and reducing the deficit and that kind of stuff, that could really throw a wrench in this whole market recovery.
Yeah, but I don't think they're going to start talking reducing the deficit. Did you see what Joe Biden proposed? The biggest deficit in history, like $6.8 trillion or something.
Right.
And of course, it's not all going to go through, but that's the starting point to back up from.
Right. So the big wild card is it is basically Republicans in Congress who are the big wild card here, because a lot of them do have this austerity thinking, and they do have this thinking of we reduce the debt, etc. And that could, because I don't want that to happen, and then people will say, "Hey, Nima, you said everything was fine." Well, I can only give conditional predictions, right? I'm not like a Peter Schiff who tells you, "I know exactly what's going to happen. It's going to be collapse, and gold is going to go to $50,000." By the way, buy my gold. By the way, but I can tell you based on scenario A, scenario B, what's going to happen if the deficits remain big, if the taxes remain low, if there's no issues there. And there's actually an issue with Democrats, because Democrats want to raise taxes. So these are kind of like the wild card issues. And then guess what? If they start doing austerity, then yes, that will hurt the banking system. That will cause people to be unable to pay their loans. That's exactly what happened in 2007, 2008. So yeah, there will be problems in the banking sector, which will stem from more from this issue of fiscal policy more than anything else. But at the moment, it doesn't seem like that's going to happen. So we'll have to keep our eyes peeled and watching that.
I think this is also important to point out that tax season's coming up.
Well, yeah, that's the thing. So that's what I'm saying.
There's going to be a net drain, and this happens every year. There's going to be a net drain out of the economy into the government. So like April, May always has that going on.
Exactly, and that's why, that's going to happen this month. There's going to be a lot of money drained from the private sector, and then probably into May too. So there's probably going to be a not too good couple of weeks, or maybe a month and a quarter or so. We'll see, but yeah, that's possible.
Word. Okay. Well, this has been Dylan Moore and Nima Majur of Irita TV. I hope you enjoyed the show. We had quite a few requests for something like this, and I'm glad we were able to do it. And I mean, maybe we'll be analyzing a few more banks after this if things continue to get weird like this German literary character did in the state of California. Yep. Cool. Thanks, Nima.
Thank you.
Oh, yeah. Check us out at irita.tv. That's the website. You'll find more of our stuff there. Thanks for watching. See you next time.